Hello guys and welcome back to Trade to Learn. Today we'll be talking about ETFs. An ETF is a type of security that's very common and it's a great way to diversify your portfolio. Diversification is very important to have a safe and strong portfolio. This is because it makes sure that if a specific sector crashes, you'll still have a backup plan. So let's get right into ETFs. An exchange-traded fund, also known as ETF, is a type of security that tracks an index, sector, commodity, or other assets which can be purchased or sold on a stock exchange just like a stock. An ETF can also be structured to track anything from a price of an individual commodity to a large and diverse collection of securities. An ETF is called an exchange-traded fund because it's traded on an exchange just like stocks are. There are many types of ETFs that investors can buy on a stock exchange. Here's a brief description of the most common types of ETFs on the market today. Bond ETFs are used to provide regular income to investors. This income distribution depends on the performance of the bonds. They might include government bonds, corporate bonds, state bonds, or local bonds. But bond ETFs don't have a maturity date. This means they don't expire. Stock ETFs are made of a basket of stocks to track a single industry or a single sector. For example, a stock ETF may track tech stocks or foreign stocks. The aim is to provide a diversified exposure to a single industry, one that includes high performers and new entrances with potential for growth. An industry ETF or sector ETF is quite similar to a stock ETF. They focus on a specific industry. For example, an energy sector ETF would include companies operating in that specific sector. The idea behind this is to gain exposure to the upside of that industry by tracking the performance of companies that operate in that sector. One example is the technology sector, which has witnessed an influx of funds in the recent years. At the same time, the downside of a volatile stock performance is also in that ETFs because they don't involve direct ownership of securities. Now we'll talk about the most common types of ETFs in the market today. Some ETFs track an index of stocks, creating a broad portfolio, while others target specific industries. First off, the SPDR S&P 500 is the oldest surviving and most widely known ETF that tracks the S&P 500 index. Next, the iShares Russell 2000, which tracks the Russell 2000 Small Cap Index. Third, the Invesco QQQ indexes the NASDAQ 100, which typically contains technology stocks. Fourth, the SPDR Dow Jones Industrial Average, which represents the 30 stocks of the Dow Jones Industrial Average. Finally, the sector ETFs that track individual industries such as oil, energy, financial services, REITs, and biotech. That was all for today. We talked about the main points on ETFs. They might not be for you, but it's definitely something you'll want to know about. Hope you enjoyed, and if you did, make sure to like and subscribe. We're almost at 100 subscribers, so let's see if we can get there by the end of the month. That was it, and see you next time!